Welcome, deep divers. Buckle up because, wow, we're navigating through one of the most head-spinning, just exhilarating periods of tech innovation I think we've ever seen.
It really feels like that, doesn't it? Every single day, something new.
Exactly. A new headline, a fresh breakthrough, and honestly, just a dizzying pace of change. It can make even the most, plugged in among us feel a little behind sometimes.
Yeah.
And if there's one sector truly driving this relentless acceleration, especially lately, it's got to be artificial intelligence.
No question.
The shifts we've witnessed, particularly around the foundational hardware, the stuff that powers all of it, well, it's captured attention everywhere. Wall Street, decentralized communities, you name it.
Indeed. And what's truly fascinating here, and I think frankly critical for everyone to understand, is that we're really standing at a profound inflection point. Right in the bedrock of this AI revolution, the chip manufacturing landscape.
Okay.
So today we're taking a deep dive into, the recent developments with Nvidia, the formidable challenges popping up from its competitors, and the really profound, often kind of underestimated implications these shifts are having on the intertwined worlds of crypto and Web3.
Right, they're definitely connected.
Totally. And this isn't just about tracking daily market ups and downs. It feels like a really pivotal moment, shaping the future trajectory of tech and, investment strategies for maybe decades to come.
Absolutely. And our mission here with the deep dive is precisely that, to help you navigate these incredibly complex, multifaceted shifts. We've gone through a stack of meticulously curated articles, in-depth research, some insider insights, and we're here to distill them down into the most potent, most important nuggets of knowledge for you.
Get right to the good stuff.
Exactly. We want to offer you a true shortcut to being genuinely well-informed, complete with those surprising facts, those practical takeaways, all without that overwhelming feeling of, drowning in an ocean of information. Think of us as your guides through the data wilderness.
That's spot on. Our aim isn't just to report the news, right? Or give you some dry summary.
No way!
We're here to connect the dots, the ones that might seem disparate, to really uncover the why behind these big market movements, and most critically, to articulate what they truly mean for the future of our entire digital infrastructure.
Yeah.
From the massive centralized clouds housing generative AI all the way to the most cutting-edge decentralized networks. We're looking at the broader context, the ripple effects across multiple domains.
Okay, so before we truly dive deeper into how NVIDIA's recent, let's call it a wobble, could profoundly reshape the playing field for new AI chip leaders, and crucially, what that specifically means for crypto and Web3, we have a quick but honestly incredibly important request for you listening.
Yeah, this really helps us out.
It does. If you find real value in these deep dives, if you appreciate us, sifting through the noise to bring you clarity and maybe some actionable insights, please just take a moment to engage with our content.
It takes like 2 seconds.
It really does. Liking this deep dive, subscribing to the channel, hitting that notification bell, it genuinely makes a colossal difference. It directly supports our team. It significantly boosts our visibility in the algorithm.
Which is huge these days.
Totally huge. And it allows us to continue creating this kind of high-quality, in-depth crypto and tech content for you. It's such a small action on your part, but it really enables these valuable deep dives to happen.
We really appreciate it.
We do. So thank you for that, and now let's get started. All right, let's dig into the heart of the matter then. For what feels like an eternity in tech time, maybe a year and a half,
Yeah.
NVIDIA has been nothing short of a titan in the AI chip sector.
Oh, absolutely. A giant.
Their rise, it was meteoric, made their GPUs, their graphics processing units, practically synonymous with cutting-edge AI compute.
Yep. You needed AI. You needed Nvidia.
Pretty much. Everyone, it seemed, was scrambling, begging, sometimes even paying these outrageous premiums just to get their hands on NVIDIA's chips. They became the undisputed kings of the AI gold rush.
And you hit on something crucial there. It wasn't just luck or good marketing, though they had that too.
Right.
It was fundamentally propelled by this insatiable, almost exponential demand for raw AI compute power. Their CUDA platform, that proprietary software layer, it became the industry standard.
Huge moat.
Massive moat, effectively positioned them as the undisputed kingmaker. Businesses, researchers, even governments, and they all needed NVIDIA's GPUs. especially those big ones, the H100s, the A100s, to train those huge language models and advanced AI systems.
Yeah.
This created a supply-demand imbalance unlike almost anything we've seen in recent tech history. That's what fueled that incredible stock performance and their market dominance.
And that phenomenal run, which honestly felt almost unstoppable for a while.
It did.
That brings us to right now. Or we're definitely not talking about a collapse. Not at
Oh,
all.
no, far from it.
We have seen a notable retreat in Nvidia's stock recently, a significant pullback after months of just relentless, almost parabolic growth.
Right, enough to make people sit up and take notice.
For sure. It's raised serious eyebrows across the market, sparked intense conversations about what's next. Is this just a blip, or is it something more?
Well, that makes me wonder what's truly behind this pullback then. Our research, looking across multiple sources, investors.com, MarketWatch, it points to kind of a confluence of several critical factors coming together.
Okay, like what?
Firstly, you started seeing significant valuation concerns bubble up.
The price got too high.
Exactly. When a company's stock trades at these extreme multiples of its earnings, sometimes, a forward PE ratio north of 60 or 70, that's way above the historical average, even for super high growth tech.
Yeah, it's steep.
Very steep. So market analysts, big institutional investors, they started to seriously question, is this sustainable? Had the stock already priced in years, maybe even a decade of future growth? That naturally leads to a strong inclination for investors to just rebalance, lock in those truly substantial gains they've made.
Can't blame them there.
Not at all. The key insight here, I think, is that even the most innovative company's valuation eventually faces, market gravity. Nvidia's pullback wasn't necessarily a rejection of its tech,
Right.
but more a classic case of institutional investors cashing in on those unprecedented gains. It signals a market rebalancing, maybe a maturing, rather than some fundamental flaw in the company.
Okay, valuation. What else?
Secondly, we're seeing the emergence of potential supply chain constraints.
They can't make them fast enough.
Pretty much. The sheer, almost unfathomable demand for these super cutting-edge AI chips is pushing hard against the limits of current global manufacturing.
Right.
We're talking incredibly complex, specialized processes here, especially in advanced packaging tech like CoWoS, that's chip-on-wafer-on-substrate.
CoWoS, okay.
It's this revolutionary, incredibly complex way of stacking different chip components, like the GPU and the high-bandwidth memory, right onto a single substrate. Boosts performance and efficiency like crazy.
But hard to do.
Very hard. There are only a handful of places in the world, mostly TSMC, that can actually produce these things at the scale and precision needed. Their capacity, while huge, isn't infinite.
Right. Creates bottlenecks.
Exactly. Bottlenecks can lead to slower production, longer lead times for delivery, and ultimately, that impacts NVIDIA's ability to meet those future demand projections, which inevitably affects their revenue forecasts and investor confidence, the insight. The physical world of manufacturing sometimes just can't keep pace with the digital demand for AI. Hardware limits become real limits.
Makes sense. Valuation, supply chain.
Yeah.
You mentioned a third factor.
Yeah, we kind of touched on it with the valuation part. Institutional profit-taking, it's played a really significant role.
The big players selling off.
Exactly. Large institutional investors, think massive pension funds, mutual funds, hedge funds, they don't just buy and hold forever, especially after a stock has shot up hundreds of % in, a relatively short time.
Right. They need to manage risk.
Precisely. After those kinds of astronomical gains, they often strategically rebalance their portfolios, mitigate risk, realize profits.
So they sell some Nvidia.
They sell off portions of these highly appreciated assets to maintain their target allocations, reduce concentration risk, maybe redeploy that capital into other sectors they think are undervalued now.
Got it.
And when institutions move billions of dollars, even if it's just a small percentage selling across multiple funds, that creates considerable downward pressure on a stock, contributes to these market corrections. So you put those three together, valuation, supply chain, profit-taking, it creates this powerful mix that really explains the recent retreat pretty well.
That certainly paints a much clearer picture of what's happening right now. But looking ahead, does this retreat signal a fundamental shift in NVIDIA's long-term trajectory? Or is it, like you said, just a healthy correction in a super overheated market? What's your gut feeling? How deep does this go?
That's the trillion-dollar question, isn't it? My sense is it's probably more of a necessary recalibration than a fundamental, irreversible decline.
Okay.
NVIDIA's technology, it remains incredible in many ways. But the insight, I think, is that the market is starting to demand more maturity, more sustainable growth metrics, rather than just purely speculative momentum driving the price.
Right. Show me the long-term plan.
Exactly. So this pullback, while it felt sharp, it forces a reevaluation. And crucially, it opens the door for a much more diversified, more competitive landscape. It's like a sign of the market growing up, moving beyond that initial almost frenzied gold rush phase.
Indeed, the market really hates a vacuum, doesn't it? Or at least a single point of failure. And as Nvidia navigates these new currents, these shifting sands, it's clearly opened pathways for other pretty formidable players. Our sources are pointing to maybe a new guard of emerging winners.
Uh-huh.
Other AI chip makers who are rapidly gaining ground as Nvidia kind of adjusts its footing. Specifically, we're talking about established players like AMD, Broadcom, and Marvell Technology.
And what's really fascinating here is why these specific players are gaining traction now. It's not just about trying to directly replicate NVIDIA's top GPUs, although AMD is certainly doing that and doing it powerfully. There are MI300 series.
We'll get into that, yeah.
But it's also fundamentally about offering competitive, high-performance alternatives, or, critically, specializing in different but equally crucial niches within the broader AI supply chain.
Okay, so not just GPUs.
Right. Take Broadcom. They aren't primarily a GPU maker, but they are an absolute titan in networking hardware and custom silicon solutions.
Ah, the connections between the chips.
Exactly. In these massive AI data centers, even the fastest GPU in the world is useless if data can't reach it quickly and efficiently. Broadcom's high-speed interconnects, their switches, specialized communication chips, they're absolutely vital for moving the astronomical amounts of data needed for AI training between literally thousands of accelerators.
Okay, so Broadcom handles the traffic. What about Marvell?
Marvell Technology is renowned for its custom silicon solutions, or ASICs, application-specific integrated circuits.
ASICs, right? Chips built for one job.
Exactly. These are chips designed for a very specific purpose, like maybe AI inference at the edge, on devices, or accelerating particular types of AI algorithms with better efficiency and lower power consumption than a general-purpose GPU.
More efficient for certain tasks.
Way more efficient. The key takeaway here, I think, is that the AI chip landscape is rapidly moving beyond just one dominant player. It's not only about who builds the fastest GPU anymore, it's about who can fill the crucial, often overlooked gaps in the entire AI supply chain. This diversification isn't just about competition. It's really about building a more resilient, multifaceted foundation for AI itself.
That diversification definitely sounds like a healthier market overall. But couldn't you argue that by fragmenting, you might lose some of those scale benefits that allowed Nvidia to dominate so effectively in the first place? Is there a risk that having too many niche players leads to less overall innovation, or maybe just more complexity for developers trying to build on top of it all?
That's a really perceptive point, and yeah, it's a valid concern. Fragmentation can introduce complexity, especially in the short term. Developers might need to learn different tools, different architectures.
Right.
However, I'd argue the deeper insight here is that while it might be messier initially, it also fosters a much more robust and ultimately more innovative ecosystem in the long run.
How so?
While NVIDIA's dominance, while powerful, also created a potential single point of failure, right? And you could argue it potentially stifled some alternative approaches that didn't fit their CUDA mold perfectly. With more players in the game, we'll likely see more specialized innovation, solutions that address specific AI workloads much more efficiently. Maybe some tasks are just better suited for AMD's GPU architecture, while others might absolutely thrive on a custom ASIC from Marvell, designed specifically for, say, running AI on a smartphone battery.
Okay, optimized solutions.
Exactly. So this isn't just a challenge to NVIDIA. It feels like a fundamental maturation of the entire AI hardware industry, moving towards optimized solutions rather than a one-size-fits-all approach. And this emphasis on a broader ecosystem, it's critical. It highlights that the AI chip landscape is much, much broader than just general-purpose GPUs, even though, yeah, they tend to grab all the headlines. Precisely. We're witnessing this profound diversification across the entire AI supply chain. Beyond just the raw compute power of GPUs, these other components are becoming increasingly vital, especially for specialized AI workloads.
Like the networking gear you mentioned.
Exactly. Networking hardware is paramount. Fastest GPU, useless if data is stuck. We're talking high-speed interconnects like InfiniBand or Ethernet switches handling terabits per second, specialized communication chips enabling seamless data flow across massive clusters.
Okay. And the custom silicon.
And the growing importance of custom silicon, ASICs. GPUs are versatile, sure, but ASICs offer superior efficiency, lower power use for their specific tasks. That makes them ideal for inference at scale in data centers or for AI tasks directly on devices, smartphones, smart home gadgets, cars, you name it.
So specialized chips for specialized jobs.
Right. This trend towards specialized chips for specific functions like dedicated AI accelerators for video processing or natural language processing creates immense new market opportunities for a wider array of companies, from nimble startups to established players. It suggests a more robust, more distributed, and ultimately more resilient ecosystem for AI development, moving beyond that monoculture we saw with Nvidia's near-total dominance.
This shift really does feel like a broader maturation then. Moving beyond one dominant player to a more varied, competitive, specialized landscape. It kind of reminds me of the early days of personal computing, right? Where a few giants dominated, versus today's incredibly diverse ecosystem of processors, accelerators, cloud services.
That's a great analogy.
The fundamental insight seems to be that the very infrastructure of AI is becoming sort of decentralized in its supply and design, laying the groundwork for maybe greater resilience and hopefully more innovation down the line. Now, here's where it gets really interesting, I think, especially for our listeners who are deep into crypto and Web3. We've been talking all about this evolving landscape of AI, chips, Nvidia, AMD, the whole gang. But what's the fundamental connection? What's the foundational link between AI and blockchain that brings all these high-powered chips so squarely into the picture? It might not be immediately obvious to everyone.
No, it's an excellent point to clarify because the connection is actually quite direct and, frankly, undeniable once you peek under the hood. Many of the very same high-performance chips, and yes, GPUs in particular that are powering the most demanding AI computations, are also absolutely essential for things like crypto mining and other intensive blockchain calculations.
The shared hardware need.
Exactly. Think about it. Both AI model training, especially for these gigantic models like GPT-4 or the new generative AI stuff,
Which need tons of power.
tons, and certain blockchain consensus mechanisms, particularly proof of work, like Bitcoin or what Ethereum used to use, they're both incredibly computationally intensive. They demand massive parallel processing power.
Doing lots of calculations at once.
Precisely. The sheer computational intensity of training a complex neural network, all those millions of matrix multiplications, it's actually mirrored in the vast number of hash calculations a miner needs to perform to secure a blockchain and validate transactions.
Interesting parallel.
It creates the shared, voracious demand for specialized hardware. And GPUs, with their architecture designed perfectly for doing many simple calculations simultaneously, they're just ideally suited for both tasks. That makes them a critical common denominator in this, digital arms race.
Okay, so they need the same powerful engines. So if we start seeing a stronger, more diverse, maybe more competitive AI chip ecosystem, more players, more specialized hardware, maybe even better pricing down the line because of competition, what does that actually mean for the blockchain and Web3 world directly? How do these shifts in silicon manufacturing ripple through to our decentralized future?
Right. Connecting this to the bigger picture, a more robust and competitive AI chip market has several really profound cascading implications for blockchain and Web3.
Okay, like what?
Firstly, and maybe most directly, it leads to enhanced compute availability.
Just more chips available.
More chips, a wider array of suppliers, diverse offerings from those general-purpose GPUs to specialized ASICs. There's simply more high-performance computing power accessible in the market overall. And this increased competition isn't just about having choices. It could also drive down costs over time.
Cheaper compute.
Yeah.
That's big for decentralized projects.
Huge. It makes advanced compute potentially more affordable for dApps and protocols that have historically struggled with the really high expense of top-end hardware.
Okay, availability and potentially cost. What else?
Secondly, this enhanced compute capacity is absolutely crucial for accelerating the integration of AI capabilities into blockchain applications and Web3 platforms.
Putting AI on the blockchain.
Exactly. Imagine the possibilities. Smart contracts that can leverage on-chain AI models for incredibly sophisticated decision-making. Think dynamically adjusting lending rates based on real-time market sentiment analyzed by an AI, or decentralized autonomous organizations, DAOs, using AI to analyze complex governance proposals, maybe manage treasuries with predictive analytics, or even detect fraudulent activity within the DAO itself.
That becomes much more feasible.
Far more feasible and cost-effective when the underlying hardware infrastructure, the chips, is abundant, efficient, and readily available. The whole concept of decentralized AI starts to feel much closer to reality.
Right. More compute power enables more complex on-chain actions.
Precisely. And thirdly, this infrastructure growth could unlock entirely new use cases that we haven't even fully imagined yet. For decentralized AI, for verifiable computation, for truly intelligent, adaptive Web3 experiences.
Like what kind of things?
We could see the rise of decentralized AI marketplaces, where anyone can contribute their spare compute power or data to train models, and you get verifiable proofs of that computation recorded right on the blockchain.
Trustless AI training.
Potentially. Or imagine NFTs, non-fungible tokens, that are truly intelligent and adaptive. Maybe their artwork or attributes evolve based on real-time market sentiment analyzed by an on-chain AI model, creating truly dynamic digital assets.
That's why.
Or AI agents operating autonomously within Web3 environments, managing digital identities, performing tasks for users with verifiable transparency. The foundational layer for all this innovation, the ability to access readily available high-performance chip infrastructure that becomes the crucial enabler.
That's incredibly compelling. It really paints a vivid picture of where things could go. But this leads me to another thought. What message does Nvidia's, let's say, inability to maintain absolute dominance send to the investors and the innovators deep in the crypto space? Does it signal a new era for how we approach building in Web3? Maybe suggesting that relying on single centralized giants, even for hardware, might be inherently risky.
That makes me wonder, too, if a single giant like Nvidia can't maintain an iron grip on this foundational technology, it sends a really powerful signal to the decentralized world, doesn't it?
Feels like it.
It suggests a profound democratization of innovation. If reliance on just one vendor diminishes, it implicitly tells us that smaller, more agile players, both in hardware development and in building protocols on top, might have a greater chance to innovate and drive adoption right at that convergence point of AI and blockchain.
Less of a gatekeeper.
Exactly. It removes a potential bottleneck, a single point of control that could stifle that permissionless innovation that Web3 thrives on. The insight here is kind of cool. Decentralization isn't just a philosophy for networks anymore. It's increasingly becoming a reality in the foundational hardware supply chain itself.
Interesting perspective.
This shift also strongly encourages a greater focus on specialization. Instead of everyone just trying to build the next general-purpose supercomputer chip,
Right.
we might see more development of niche solutions, both in hardware and in the protocol layers. Imagine chips optimized specifically for the incredibly complex math needed for zero-knowledge proof.
Which are huge for privacy and scaling in Web3.
Absolutely vital. Or chips designed specifically for running small, efficient AI models directly on decentralized networks right at the edge. This benefits specific AI blockchain needs by providing tailor-made, highly efficient, and potentially more secure solutions than trying to adapt a general-purpose chip.
Right tool for the right job.
Exactly. And critically, for investors listening, this shift signals a broadening of new investment opportunities beyond just the obvious incumbents, beyond just Nvidia or AMD.
Looking beyond the giants.
Yeah. It means potentially benefiting less-known projects. Maybe they're developing alternative hardware solutions, or more relevant for our crypto listeners, maybe they're building the decentralized networks and protocols that are specifically designed to leverage this more diverse and accessible compute landscape.
Okay.
This burgeoning competition fosters a healthier, more distributed, and ultimately, I think, more innovative ecosystem for everyone involved, from the chip designers all the way to the dApp developers building on top.
That makes perfect sense. So this raises an important question then. If Nvidia isn't the sole leader anymore, who truly drives innovation at the intersection of AI and blockchain, it sounds like it might be less about one titan dictating the pace and more like a mosaic of smaller, more specialized players working together, maybe even competing fiercely.
I think that's exactly right.
That shift in power dynamics could profoundly reshape the entire tech landscape, couldn't it? Okay, let's try and unpack this with some concrete examples from our sources. It's one thing to talk theory and market shifts, right?
Need to ground it.
But how are these chip demands and these market movements actually playing out in the real world of crypto and AI? These case studies should help solidify the picture for everyone.
Indeed. Seeing these concepts in action really brings them to life, and our sources provide some excellent examples that vividly illustrate this critical overlap and the emerging trends we've been discussing.
Great. Where should we start?
First, let's talk about the render network, or RNDR. You described it earlier as a fascinating example of leveraging distributed GPUs.
Yeah, it seems like a perfect fit.
And it absolutely is. R&DR directly ties into this surging chip demand by using a decentralized network of GPUs for tasks like, high-end 3D rendering, complex visual effects for movies and games, but also, increasingly, for AI model training and inference.
There's people sharing their GPU power.
Exactly. Imagine independent artists, big animation studios, or even AI researchers who need massive amounts of computational power, but maybe only for a limited time.
Right. Buying racks of GPUs is expensive if they sit idle.
Super expensive. And relying on centralized cloud providers can also be costly, sometimes opaque, so instead they can tap into this global network of idle GPUs.
Whose GPUs are they?
Owners of these GPUs could be professional gamers, digital artists, maybe even former crypto miners with hardware left over. They can lend their unused processing power to the network.
And they get paid.
They earn R&DR tokens in return. This showcases a direct, tangible blockchain chip synergy. The crypto token's utility is explicitly and intrinsically linked to the underlying hardware demand for AI-related tasks. It provides a verifiable service powered by that hardware. It's essentially a decentralized compute marketplace built right on the back of GPU infrastructure.
That's a really clear example. Okay,
Yeah.
you mentioned CoreWeave earlier, too.
Oh, yes, CoreWeave.
This one really stood out to me in the research. A company that started squarely in crypto mining.
Yep.
And then, in what seems like a brilliant strategic move, completely pivoted, or maybe expanded, into AI cloud services. How did that transition happen so effectively? And what does it tell us about the foundational power of just having that GPU infrastructure?
CoreWeave's journey, which sources like ARK Invest have analyzed quite well, is just a fantastic illustration of how transferable this GPU infrastructure really is.
Okay.
They began as a major crypto mining operation, right? Strategically accumulating vast quantities of Nvidia GPUs back when mining was super profitable.
Got it. Lots of GPUs.
Then, when the crypto markets shifted, particularly with Ethereum moving away from proof-of-work mining, or maybe as they just acutely recognized the absolutely burgeoning explosive demand for AI compute.
They saw the writing on the wall.
They didn't just sell off their hardware like many others did. Instead, they cleverly leveraged the pre-existing massive GPU infrastructure and, importantly, their considerable operational expertise in managing thousands of these things running 204/7.
That's key, too, knowing how to run them.
Definitely.
Mm.
So they pivoted, or maybe expanded is the better word, to become a leading cloud provider specifically tailored for AI workloads.
Wow.
It just vividly demonstrates how the intense computational demands of crypto mining inadvertently built out this foundational infrastructure, these huge farms of high-performance GPUs that was perfectly suited for the parallel processing needs of AI training and inference.
Accidental AI infrastructure.
Kind of. It's a compelling narrative of adaptation, strategic foresight, resourcefulness, directly bridging that gap between crypto hardware use and AI hardware use. They went from mining digital gold to powering the AI revolution. And now they're valued in the billions, attracting huge investments, even from Nvidia itself.
Incredible story. Okay, what's next? The old rivalry.
Yes. Next up, the classic rivalry is heating up again, but this time AI is front and center. AMD versus Nvidia.
And that'll continues.
It does. Our sources, including reports from places like Cointelegraph and MarketWatch, they're extensively highlighting AMD's remarkable resurgence, specifically mentioning their MI300 series of chips.
MI300, okay. Why is that significant?
This is a crucial development because AMD's MI300X and MI300A chips aren't just, minor upgrades. They are meticulously designed specifically to challenge NVIDIA's long-standing dominance in high-performance computing and AI supercomputing.
Taking direct aim at NVIDIA's best.
Directly. The MI300X, for instance, boasts really impressive memory bandwidth and capacity, putting it right up against NVIDIA's H100 and A100 series, which have been the gold standard.
Are they getting traction?
They are. They're gaining significant traction in major data centers, research institutions, even with cloud providers. They're securing key contracts. This signals intense direct competition for future AI infrastructure deals and market share. It's definitely not a one-horse race anymore for the most powerful AI accelerators.
Which is good for buyers, presumably.
Excellent news for buyers. Fosters innovation, should drive down costs eventually, and reduces that risky reliance on a single vendor. Plus, AMD's open-source software platform, ROCm, which competes with NVIDIA's closed CED.
Right, the software matters too.
Hugely. RCM is attracting developers who prefer a more open ecosystem. That further intensifies the battle for developer mindshare and market adoption, which is critical in the long run.
Fascinating. Okay, so that's the chip giants. But what about the demand for compute within specific blockchain ecosystems themselves? Not just for AI layered on top, but for running the blockchain itself. Let's talk about Helios.
Helios is another excellent case study, and it highlights something slightly different. The sheer and growing demand for high-performance compute resources within these blockchain ecosystems.
Just to keep the lights on, basically.
Essentially, yeah, but at massive scale. Our sources, notably from Missouri's research, mention Helios's significant fundraising, raising hundreds of millions of dollars,
Oh, that's a lot.
specifically for scaling Solana's infrastructure. Now, this isn't primarily about crypto mining in the traditional sense. It's about the enormous and escalating demand for robust, scalable blockchain operations.
Okay, what kind of operations?
Solana, as you know, is famous for its super high transaction throughput and low latency. Achieving that requires incredibly powerful and reliable infrastructure. We're talking about the RPC nodes, remote procedure call nodes.
The communication layer?
Exactly. They're the communication backbone, allowing different parts of the network wallets, dApps, exchanges to talk to the blockchain quickly and reliably. Plus, you need advanced indexers to query data, powerful validators to secure the network.
So, lots of compute needed just to run Solana smoothly.
Tons. This huge fundraising underscores that even without direct AI integration, modern high-performance blockchains are themselves compute-intensive beasts. They're driving substantial demand for the very same advanced hardware high-end CPUs, GPUs that AI models crave. It's about ensuring the foundational layers of Web3 can handle the increasing load and complexity. It underpins this broader infrastructure race that's as much about blockchain scaling as it is about AI training. The insight. High-performance blockchains are also these silent consumers of advanced chip technology, driving demand right alongside AI.
That's a really important point. Okay, let's zoom out now to the very top. How does all this fit into the bigger picture? We see tech giants investing just astronomical sums in AI. The OpenAI and Microsoft Azure partnership is maybe the biggest example.
Right, the OpenAI and Microsoft Azure partnership. It's been covered extensively, places like investors.com, MarketWatch. It's a prime, maybe the ultimate example of how foundational this chip race truly is, even at the enterprise level where they have the deepest pockets imaginable.
How so?
This high-profile collaboration isn't just about software, right? Not just about advanced AI models like GPT-4. It's deeply and intrinsically tied to securing and developing massive advanced chip infrastructure.
Building the factories for the AI.
Precisely. Microsoft has poured billions into OpenAI, and a significant chunk of that investment goes directly into building out these massive, bespoke supercomputing clusters on Azure, clusters required to train and run OpenAI's cutting-edge models.
And that means buying chips. Lots of chips.
Tens of thousands of advanced GPUs, specifically Nvidia's H100s currently. And potentially they're even co-designing custom chips with partners to optimize their specific AI workloads even further down the line. It just emphatically emphasizes that even the largest tech players with virtually unlimited resources are actively locked in an arms race to secure and develop the most advanced chip infrastructure to support their AI ambitions. This highlights the foundational absolute necessity of these chips for any deep AI integration, let alone AI plus Web3 integration, especially as AI moves from niche research into mainstream enterprise apps. It's a silicon arms race on a global scale. Everyone wants the best arsenal, demonstrates the critical importance of chips for the future of digital innovation at every single level.
Okay, so we've talked about the big picture, the shifts, some fascinating individual stories and case studies. But what does this all actually mean for you, our listener, especially if you're an investor or a trader trying to navigate this incredibly dynamic landscape?
Yeah.
How can we effectively track these shifts beyond just reading the daily headlines? What should we be looking at?
Right. This is where we try to bring the insights back to some actionable intelligence. For investors and traders, tracking these trends really requires a multifaceted approach. You need to look at traditional equities, sure, but also the rapidly evolving crypto space.
Okay, where do we start on the traditional side?
First, let's look at equities. AI chip stock performance. Pretty straightforward, but crucial. You'll want to focus specifically on tracking Nvidia versus AMD versus Broadcom stock performance. Watch them closely, particularly through Q3 and Q4 and well into next year.
Comparing the big three directly.
Exactly. While AI chip stocks might remain volatile in the short term because of those revaluations, the supply chain stuff we discussed, they absolutely represent immense long-term growth opportunities. So monitoring their movement, especially how they react to things like earnings reports, guidance on future demand, new product announcements.
Like AMD's MI300 getting wins?
Precisely. That's critical. If you see sustained outperformance by AMD or Broadcom against Nvidia, that would signal a tangible shift in market sentiment and potentially a real shift in market share starting to happen. The insight here is that while individual stock movements can be noisy day to day, the relative performance between these giants offers a clearer signal about the changing dynamics of market leadership.
Okay, relative stock performance. What else?
Next, consider institutional interest. ETF inflows. This gives you a crucial macroscopic view. It shows where the big money, the institutional capital, is moving.
How do we track that?
Track the inflows into AI sector exchange-traded funds, ETFs. Common ones are BOTZ or SMH, for example. These ETFs hold diversified baskets of semiconductor and AI-related stocks.
So you see if money is flowing into the whole sector.
Exactly. Significant sustained inflows here indicate that large institutional capital is being allocated to the broader AI infrastructure theme, not just picking individual winners. It reflects a collective institutional belief in the sector's long-term potential. And often, these flows can predate or reinforce individual stock movements, offering a strong indicator of broader market sentiment towards AI chips. It's like checking the pulse of the entire industry, not just one company's heartbeat.
Right, that makes sense. Okay, now for the crypto side, this is a really crucial one for our crypto-focused listeners. Do these AI-related crypto tokens actually move in sync with the chip stocks? Or is it all just hype and narrative driving your prices? Sometimes it feels like they decouple, other times they seem tightly linked.
That's precisely the correlation we need to analyze, and yeah, it's definitely a nuanced one. Our sources, including research from places like Masari, suggest that yes, often AI-related crypto tokens think RNDR, Render Network, FetchET, Fetch.ai, AGIX, SingularityNet. They do often mirror the movements of the AI stock leaders, particularly Nvidia and AMD.
Interesting. So there is a link.
It implies a deeper connection than just pure speculation or, fleeting hype. When sentiment around AI hardware is strong, or when major players like Nvidia or AMD see significant shifts in their stock performance, it seems to create this ripple effect that extends to projects fundamentally leveraging or building on the AI infrastructure, but in the decentralized space.
Okay.
Now, this correlation can be a double-edged sword, right?
That's it.
It means these tokens often benefit from positive news and bullish sentiment in the broader AI sector, which is great on the way up. But they can also be susceptible to downturns or pullbacks in the chip stocks on the way down.
Got it. Linked fortunes.
Somewhat. Understanding this dynamic is vital for investors looking to diversify their portfolios across AI and blockchain convergence. It helps inform whether you're truly diversifying your risk or maybe just shifting your exposure within what might be a highly correlated segment at times, the insight. Despite the perceived independence of crypto, its AI-focused tokens seem tethered, at least partially, to the real-world performance and perception of that foundational hardware sector.
Okay, that's a key takeaway. What other indicators are there? Maybe less obvious ones.
A more granular and perhaps surprising indicator is to monitor GPU resale markets.
Like eBay prices for graphics cards.
Essentially, yeah. It might seem unconventional, but it provides a real-time proxy for secondary demand for used hardware for both crypto mining and AI hardware.
How did that work?
Well, if the price of second-hand high-end GPUs, even older generations, that are still pretty powerful if those prices remain strong, or even increase despite new models coming out, it suggests persistent underlying demand.
Demand from who?
Could be smaller crypto mining operations, could be independent AI developers building their own little clusters, maybe even enterprises building out smaller, specialized AI environments that don't need the absolute latest bleeding-edge chip.
Okay.
A robust secondary market, even when new supply is hitting the shelves, indicates that the underlying appetite for these powerful chips just isn't waning, that the compute hunger is pervasive across various sectors, not just the top hyperscalers.
Interesting grassroots indicator. Okay, what else?
And finally, for the big picture strategists among you, keep an eye on the Nvidia dominance chart market share over time.
Tracking who actually sells the most chips.
Exactly. This is vital. Tracking Nvidia's market share against its primary competitors, particularly AMD in the AI accelerator space, provides a clear visual. Is the current stock pullback just a blip, a healthy correction? Or is it part of a sustained structural erosion of its market dominance in AI chips?
The real proof is in the sales numbers.
Right. A significant, consistent decline in their market share over several quarters would be a very strong signal that the landscape is truly diversifying, that competitive pressure is increasing dramatically, and that we're heading towards a more distributed power structure in AI hardware. This goes beyond just stock price fluctuations to the core business strength and competitive positioning within this absolutely critical sector.
Okay, lots of metrics to track there.
Yeah.
So let's bring it all together then. What's the grand narrative here? Is this just another tech trend cycle, or is it something much, much bigger that we should be paying extremely close attention to?
I think the overarching macro takeaway is profoundly significant, and this is where it all really converges. We're entering an AI plus blockchain infrastructure race, where chip providers will be as critical as protocols and exchanges.
Wow, okay, that's a big statement. As critical as the protocols themselves.
I think so. This frames the entire discussion within a massive, potentially multi-trillion-dollar narrative for the coming decade. It's all about the foundational layer.
Explain that.
Just like the early internet needed robust networking hardware and powerful servers to scale up.
Right. Cisco, Intel.
Exactly. And just like crypto needs secure, efficient protocols and liquid exchanges to thrive.
Ethereum, Uniswap.
Right. The convergence of AI and blockchain demands a powerful, resilient, and increasingly diverse chip infrastructure. The competition for who provides that backbone, the silicon that actually processes the digital future, will fundamentally shape the future of both industries. It's becoming a race not just for software dominance, but for the hardware supremacy that underpins absolutely everything else.
So is the AI plus blockchain race the real trillion-dollar narrative of the next decade? It certainly feels that way when you look at these numbers, these foundational shifts underway, the sheer scale of investment flooding into both sectors independently, let alone their convergence.
It's hard to imagine a future where these two technologies don't remain inextricably linked, powered by the very chips we've spent this whole time discussing. Hashtag tag outro.
Wow. What an incredible deep dive we've had today. Seriously packed with insights.
Yeah.
We've covered so much ground, really, from understanding Nvidia's recent retreat, the compelling reasons behind it, valuation, supply chain bottlenecks, profit-taking,
The whole mix.
to the exciting rise of these new chip players like AMD, Broadcom, Marvell Technology shaking things up.
Bringing real competition.
Yeah. We explored that direct overlap and the mutual benefits for AI and crypto infrastructure, highlighting how these chip advancements aren't just for the big tech giants, but are profoundly impacting and enabling decentralized networks and Web3 too.
Absolutely crucial link.
And crucially, hopefully, we've armed you with various actionable ways to track these evolving trends from AI, chip stock performance, institutional ETF flows, to those crypto token correlations, and even checking out GPU resale markets.
Lots to keep an eye on.
Definitely.
And just to reiterate the so what for you listening, this really isn't just about silicon or market caps or even the fortunes of individual companies. It's fundamentally about the foundational layer for the next massive wave of digital innovation across both AI and decentralized technologies.
The engine driving it all.
Exactly. The performance, the availability, the cost of these critical chips will fundamentally shape what's truly possible in the coming years. For everything from intelligent dApps and maybe self-sovereign AI agents to truly scalable, privacy-preserving Web3 experiences, these chips are the engine of our digital future.
So as we wrap up, here's maybe a final thought to chew on, something that builds on our entire discussion today. If the future of AI and blockchain is indeed tied so tightly to the chips that power them, and if access to this critical hardware becomes even more distributed, more competitive, moving beyond the grasp of just one or two dominant players, what completely unexpected innovations might emerge from that?
That's a great question.
Think beyond what we've discussed today. What novel applications, what new paradigms, maybe what unforeseen disruptions could arise from this new era of more diverse, more accessible compute power? The possibilities, they feel truly mind-bending when you start thinking that way.
It really opens things up, doesn't it, when the tools become more widespread?
It does. So we definitely encourage you to continue your own deep dives. Consider the excellent sources we've drawn from today, places like investors.com, Cointelegraph, Messari, ARK Invest, MarketWatch. Keep exploring this fascinating convergence of technologies.
Stay curious.
Exactly. The future is being built on these chips, and understanding their dynamics is really key to understanding the future itself. Thanks so much for joining us on The Deep Dive.
Thanks, everyone.
We'll see you next time.